The year was 1792. America was still a young country, barely a decade old. It had recently fought for its independence and was struggling to find its economic balance. The nation was figuring out how to stabilize its finances, and a new form of trade was emerging. The story of America's first financial crash begins not in a crowded city, but on Wall Street. Back then, Wall Street wasn't the towering, fast-paced financial hub it is today. It was just a small street in Lower Manhattan, lined with merchants and traders. However, this street would soon become the birthplace of a financial revolution that would echo for centuries. The year 1792 marked the beginning of a turbulent period in U.S. financial history. It was here that America's first great market collapse would unfold. The Panic of 1792. The Panic of 1792 wasn't just a Wall Street crash. It was a crisis that shook the very foundation of America's fledgling financial system. What caused this early collapse? It was the rapid growth of speculation, government debt, and financial manipulation. The roots of the panic can be traced to the efforts of Alexander Hamilton, the first Secretary of the Treasury. Hamilton was determined to stabilize the nation's finances and prove the new government's legitimacy. He proposed a bold financial plan to manage the nation's war debt, which included the issuance of government bonds. These bonds would be sold to investors, creating a new class of financial instruments. They became the building blocks of a new financial market. Hamilton's vision was clear. The government would pay off its war debts, secure its credit, and establish a stable economy. The bonds, which were essentially promises to pay back money with interest, became the foundation of this system. Investors and traders on Wall Street saw a golden opportunity. They began to buy up these bonds, speculating on their value. But what was meant to stabilize the economy became the very catalyst for a financial crisis. The problem was that the market for these bonds was not based on actual value or demand. Instead, it was driven by speculation. Traders were buying bonds not to hold onto them, but to sell them for a profit. Prices of these bonds began to rise quickly, artificially inflating the market. The bond prices surged, creating the illusion of economic prosperity, but beneath the surface, there were serious cracks in the foundation. This was the beginning of what we would now call a financial bubble. The value of government bonds was inflated far beyond their true worth. Investors were not concerned about the bonds' true value. They were simply looking for the next person to buy them at an even higher price. This kind of speculation can only last for so long before the bubble bursts. Amid this chaos, William Dewar, a former Treasury official, saw an opportunity to leverage the inflated bond market. Dewar had been involved in the early bond trading, and he began borrowing heavily to buy more bonds. He used the bonds as collateral to secure loans from banks and other financial institutions. At the height of the speculation, Dewar was deeply indebted, but he believed that the prices of bonds would continue to rise. He was confident that he could sell the bonds for more than he had paid, paying off his loans and making a profit. However, things quickly spiraled out of control. Dewar's downfall began when he was unable to repay the loans he had taken out. When his creditors demanded repayment, he defaulted on his debts. This triggered a chain reaction. Other investors, who had been borrowing heavily to purchase bonds, also found themselves unable to pay back their loans. They began to panic and tried to sell their bonds, hoping to raise cash. But as the market flooded with bonds, the value of the bonds began to plummet. The price of the bonds crashed, and investors who had speculated on the bond market were left with worthless paper. The financial world, which had been soaring just days earlier, collapsed. Banks that had lent money to these speculators were suddenly facing huge losses. The panic spread quickly, and soon Wall Street was in turmoil. But the effects of the crash were not confined to Wall Street. The panic quickly spread throughout the nation. Businesses that had invested in the bond market were now in trouble. Credit dried up and banks became reluctant to lend money. The ripple effects reached every corner of the economy. People began to lose confidence in the financial system, and the nation's economic future looked uncertain. What made the Panic of 1792 so dangerous was how quickly it spread. The collapse wasn't just about the bond market, it affected the entire economic structure of the country. The new government, which had hoped to build a strong and stable economy, was now faced with a crisis that threatened its very existence. The Panic of 1792 showed just how fragile the country's financial system was. The crisis also revealed that the young republic was not immune to the forces of speculation and financial mismanagement. The most interesting part of this story is how quickly Alexander Hamilton moved to address the crisis. Hamilton, the architect of the financial system, was not one to sit idly by when the nation's financial structure was under attack. He understood that the crisis needed immediate action to prevent a total collapse. Hamilton's quick thinking and decisive actions helped prevent a total disaster. Hamilton stepped in by negotiating a deal with the banks. He arranged for the federal government to step in and provide financial backing to the banks that were on the brink of failure. This infusion of government support helped stabilize the banks and calm the panic. Without Hamilton's intervention, the financial collapse could have been much worse, possibly leading to a much deeper recession or even a depression. Despite the chaos, the panic was brought under control. The immediate damage was mitigated, but the scars of the Panic of 1792 would remain for years to come. The crisis exposed the vulnerabilities of the U.S. financial system, and it highlighted the need for greater regulation and oversight. The lesson learned from the Panic of 1792 was clear. Speculative bubbles could destabilize the economy, and financial systems needed stronger safeguards. The immediate aftermath of the Panic of 1792 left the United States in a fragile position. Though the financial system had been stabilized with government intervention, the panic revealed critical weaknesses in America's economic structure. The financial landscape was still young, and the experience of the crash exposed just how vulnerable it was to speculation and mismanagement. But Alexander Hamilton, who had steered the country through the storm, wasn't about to let the crisis define the future of America's financial system. He understood that in order for the U.S. economy to thrive, it needed a centralized and stable financial system. Hamilton believed that a strong national government would provide the necessary stability for the economy. Thus, his financial reforms were aimed not just at recovery, but at creating a long-term foundation for the nation's financial future. Hamilton's response to the crisis involved strengthening the federal government's role in economic matters. In 1791, just the year before the crash, Hamilton had already pushed for the creation of the first Bank of the United States. This bank, similar to modern central banks, was designed to centralize the nation's finances and control inflation. It acted as a depository for federal funds, helped issue a national currency, and regulated the nation's financial institutions. The bank was part of Hamilton's broader vision to establish a sound financial infrastructure. Though controversial at the time, this centralization would prove critical in avoiding further financial chaos. The creation of the first Bank of the United States was, in many ways, a direct response to the financial instability that the Panic of 1792 had exposed. As the years went on, Hamilton's financial policies continued to shape the country. His policies laid the groundwork for a more regulated financial system. In the decades following the Panic of 1792, the U.S. would experience a series of economic booms and busts. However, the financial system would gradually become more stable due to reforms that emerged from the lessons of the 1792 panic. One important outcome of the Panic of 1792 was a shift in public perception of speculative trading. The crash made it clear that unchecked speculation could have devastating consequences. It exposed how risky financial manipulation could destabilize the entire economy. This led to more cautious investment strategies and a greater awareness of the dangers of market bubbles. Despite the crisis, Wall Street's influence continued to grow. The market recovered, and the speculation that had fueled the crash was replaced by more measured, institutionalized trading. Over time, Wall Street would evolve into a major global financial hub. Yet, the lessons of the Panic of 1792 remained. The crash also highlighted the fragile relationship between government and business. It became evident that strong government intervention could be necessary to prevent financial systems from spiraling out of control. At the same time, it underscored the importance of personal responsibility among investors, banks, and government officials. Unchecked speculation, reckless borrowing, and lack of transparency were dangerous forces. For the United States, the Panic of 1792 was a formative event. It revealed the immense risks of financial speculation, the need for strong governmental oversight, and the importance of a stable currency. It also demonstrated that financial crises are not only about money but also about trust. Trust in the government, trust in the market, and trust in the stability of the country's financial system. Hamilton's response to the panic showed his capacity to act quickly and decisively. His willingness to step in, support the banks, and stabilize the financial system prevented the panic from turning into something far worse. In the years that followed, his vision for America's financial future took shape, with the government playing a central role in ensuring stability. Despite all the challenges, Hamilton's vision ultimately helped build the foundation for the financial system that would serve the United States well into the future. The creation of the first Bank of the United States, the regulation of currency, and the establishment of a national credit system were all part of this enduring legacy. Hamilton's influence on American finance continued even after his death, and his ideas remain relevant today. The Panic of 1792 was the United States' first real test of its financial resilience. It revealed the vulnerabilities of an emerging nation and provided a blueprint for avoiding similar crises in the future. In a way, it marked the beginning of the United States' journey toward a more modern financial system. Looking back, the Panic is a fascinating and often overlooked chapter of American history. It shows how easily an economy, even a fledgling one, can collapse under the weight of unchecked speculation. But it also illustrates how a well-designed financial system, strong leadership, and swift government action can turn a crisis into a defining moment for a nation. In the end, the Panic of 1792 was not just a Wall Street crash. It was a pivotal moment in the history of the United States, one that helped shape the country's economic future. And, despite the pain it caused, it ultimately helped establish the institutions and policies that would protect the nation from even greater financial disasters in the years to come. Today, when we look at the financial markets, the lessons of 1792 remain fresh. We still see the effects of speculation and financial crises, but the mechanisms that Hamilton put in place have endured. The Panic of 1792 was a painful lesson, but it helped the U.S. economy grow stronger and more resilient. As we reflect on that first crash on Wall Street, we are reminded of the fragile nature of markets and the enduring importance of stable financial systems. The legacy of the Panic of 1792 is not just about a crash, but about the lessons learned and the steps taken to build a stronger, more resilient financial future.